Welcome to Know Your Crypto Compliance, a YouTube series from Chainalysis centered around cryptocurrency policy, compliance, and enforcement in the fintech industry. Crypto crime report season continues here at Chainalysis. Caitlin Barnett, Director of Regulations and Compliance, welcomes back Kim Grauer, Director of Research. They'll cover the complex topic of money laundering in crypto. Caitlin's also joined in a fireside chat by a new guest on the show, Roger Brown, Global Head of Tax Strategy, who covers the changing landscape in crypto tax compliance. Hi, and welcome back to Know Your Crypto Compliance. I'm really excited for today's episode because I am joined by Kim Grauer. Kim was on our last episode of Know Your Crypto Compliance where she talked about how she got into crypto and working at Chainalysis. And today we're going to dive a little deeper into Kim's specialization. Kim is our lead researcher behind our crypto crime report. This is a fabulous report that comes out on an annual basis that I know I get really excited for, and I think the rest of the industry does as well. So thank you so much for joining me today, Kim.
Thanks for having me.
Of course. So let's get right into it. Can we review the content from the crypto crime report quickly? One of the big things that we saw was that criminals need to off-ramp, right? Meaning it's great that they can interact with crypto, but eventually they want to turn that back into fiat. So what's the percentage of illicit funds that we're seeing going to the idea of centralized exchanges?
My favorite section of our crime report each year is the money laundering section. We have a section on each type of illicit activity, and you can find the overview in the introduction. Spoiler alert, crime hit an all-time high in 2022, and a lot of that was driven from sanction activity as well as scams and hacking. But the money laundering section is really interesting just because I think it's really powerful on what this means for our customers and regulators, and the fact that we can see with just one simple query, data query, where are all the illicit funds going, and then speculate as to why we're seeing trends, things change. And one of the most important off-ramps or conversion points in crypto for illicit funds is ultimately centralized exchanges where there's a fiat conversion point. And in 2022, about 50% of all illicit funds went directly or indirectly to centralized services.
Wow, that's a pretty big number. And what do you see, what type of activity are you seeing, criminals or illicit activity targeting these centralized exchanges?
It's a really important question because it's an extremely different answer based on the crime type. So for example, scamming is one of the biggest direct users of centralized exchanges. And scammers are not typically associated with major complex money laundering schemes that you might see with a ransomware criminal or a hacker. And so the one thing we profile is the off-ramps by crime type, and there you can see tremendous variation. So hacking was one of the fastest growing categories, but most hacked funds actually, before there's a conversion point for a fiat off-ramp, they go to DeFi services. And the reason for that is simply because they have to, because oftentimes assets are stolen that are only available in liquidity pools. But then you have scams that are mostly plugging into centralized exchanges as well as sanctioned large services, which are plugging into the liquidity. They are reliant on the liquidity of centralized exchanges to function.
And I think you just brought up something really important. Obviously, if you read the report, you'll get this information, but it's not as easy as a customer is perpetrating a scam or a money laundering massive crime and then just going to the exchanges. They're taking a lot of different steps before they're trying to off-ramp at an exchange. Can you talk a little bit about that?
Yeah, again, it's something that really depends on the bad actor. There are some scams that just plug directly into a centralized exchange, and I think that the reason for that is that you don't know they're a scam a lot for quite some time sometimes until until it becomes clear that a Ponzi scheme has been operating or there's an exit scam. And so sometimes we do see that really straightforward relationship with a scam and a centralized exchange. But sometimes we see something much more complex if we are taking, for example, ransomware actors who we know are reliant on liquidity because they need to convert their stolen funds into fiat currencies. Those will use very complex, well-established money laundering networks that have been built out over long periods of time. Sometimes they'll be moving funds through thousands of cryptocurrency wallets to centralized conversion points or money laundering services that, as a part of their business model, are meant to move illicit funds. And then those will leverage other money laundering networks or bridges or DeFi or other kind of more advanced technologies before the funds actually make it to a centralized exchange to convert.
That's super interesting, and clearly very convoluted in how they get about it. But obviously the importance of the transparency of the blockchain is essential to your work in being able to identify these large patterns.
Yeah, and it kind of brings me to a question that I have for you. I live in the data all the time, but I kind of, centralized exchanges generally have compliance measures in place to prevent this activity, right? And so my question is, what's working and what might not be working here from an insider's perspective, considering we're still seeing all of these funds moving to centralized exchanges?
Yeah, it's a great question. And I always kind of describe criminals as like the game of whack-a-mole, right? Like you figure out one pattern, you put measures in place, you're able to stop it or prevent it, or at least be able to detect it fairly quickly so that you can hopefully put a stop to it, file your suspicious activity reports, close the accounts, work really closely with law enforcement to try to take down some of these networks. But to your earlier point, they're popping up left and right. And criminals are smart, for better or worse. And so, utilizing research like yours, I think, is so important to compliance officers so that they can see what the latest trends are, identify new or bad actors, new money laundering networks, to your point, so that, if we're seeing an exchange that is known for being a cash out point, maybe you do extra due diligence on that. Maybe you update your blockchain analytics so that you're getting alerts when you're receiving funds from there. It's constantly, like I said, that game of whack-a-mole trying to figure it out. And it's just so important to use research like yours to continue to strengthen compliance programs.
Yeah, I think that what that reminded me of was one of the findings from our report, which is that we not only look at what services are types of bad actors using, but we can get a lot more specific than that. We can see exactly what deposit addresses are receiving those illicit funds. And if you take an exchange, you can see, for example, if all of the illicit funds are going to a small number of deposit addresses on that service, or are they going to a wide variety of deposit addresses. And so a deposit address would probably, you can think of it like either a service operating within a service or a person's bank account.
Yeah.
And if the funds are highly concentrated, so the majority of funds are going to a few deposit addresses, then that signals that there might actually be fewer bad actors than you might otherwise think. And what we've continued to find with our research is just how much concentration there is even within these few centralized exchanges, which are moving a lot of funds. And that, to me, is a powerful way forward for compliance officers who are looking at how to make this data actionable. The fact that we can say, oh, not only these are the services that are moving funds, but these are the deposit addresses on those services.
Yeah, absolutely. And I think that brings up, a really important point. Compliance officers can do as much as they can, identify the bad activity, but the relationship between these regulated centralized exchanges with law enforcement becomes super important because, again, if you have an exchange who is a good actor in the ecosystem who is filing suspicious activity reports in whatever jurisdiction they're located in, responding to subpoena requests, because, I'm assuming law enforcement also is relying on a lot of the data that, we're providing, and then you can get that holistic picture, because law enforcement can then follow that chain very easily, whereas the exchanges are kind of limited to what they can control, which is their own body of work. So I think the collaboration across the industry is just so important. And we've seen amazing things happen when law enforcement and the private sector work together using your fabulous research.
I mean, that's great to hear that the research is useful. That's the point. We just really want to get it out into the public domain. You kind of got me thinking of another question, though. Now that we're talking about transactions entering exchanges, and we know the source might be illicit, but we also know that centralized exchanges actually can't stop incoming transactions. So given that they can't stop incoming transactions, what are some of the ways that they can strategically separate questionable funds?
Yeah. And this is a great point just to bring up for those who might be newer to crypto and blockchain in general. There is the inability to stop incoming funds. However, you can block funds from going out. So just like one point of clarification for anyone who's new to listening to this, there's a whole host of ways that different exchanges or different people are interacting with crypto and putting mitigation measures in place. One of our customers, they have coined the term that they came up with a pig pen of dirty assets, essentially, so that when funds come in, they go into this wallet that's not associated with any specific customer until they do a thorough analysis using blockchain analytics to determine if they're coming from a potentially illicit source. That's one very risk-averse way to go about it, where you're checking absolutely everything. Another way that exchanges handle this is they have what are called blacklists. And so utilizing data like yours, Kim, utilizing blockchain analytics, sanctions lists, internal research if they have identified a fraud ring or a fraud scam, just from internal investigations, they'll add those addresses to a blacklist so that they get alerted if they are receiving funds from those addresses in real time, and then can action them much quicker than relying on traditional transaction monitoring. So not perfect, obviously, due to the inherent nature of the blockchain that you can't block those incoming funds, but definitely taking as many steps as possible to highlight the teams to them quicker so that they can action them.
That's really interesting.
Yeah, it's, again, that game of whack-a-mole, but the more data, the more information you have, the better your compliance program ultimately is, in my opinion, at least. So we've talked a lot about like patterns and all different things that criminals are utilizing to try to obfuscate source and destination of funds. What kind of patterns are you seeing in the data that seem to get through compliance measures?
We see a lot of patterns. This is just to emphasize, and I emphasize this a lot, we have every single transaction that a criminal has carried out on the blockchain. Every single one.
Which is so wild to think about that.
Yeah, and we can, with that, we know a lot about who the actors are. Is it a ransomware bad actor? Is it a criminal group that we've profiled? We can get really specific on the behaviors that different groups are using. And so we're able to get really detailed on patterns. And one example of patterns that we were looking at, it was, what is the average transfer size of a transaction entering into an exchange that comes from an illicit source? And we saw a spike in the number of transactions entering centralized exchanges that are just below the travel rule. And so you'll see the number of transactions that are small, medium, and then you have this little bucket of transactions that are just right below $1,000. And you can see a surge in transactions that are hitting that threshold. But we can also look for other types of transactions as well, based on what we know about how money laundering works. So we can look at, was the account, did it receive money and then immediately send all that money out? right after from an illicit source. And that is a very typical layering strategy, just using the exchange as, or service or what have you, as a kind of touch point, and then moving the funds along. We see structured payments coming into mixers and then out of mixers and into centralized exchanges in very structured patterns that allow us to even figure out which type of bad actor, how sophisticated is the bad actor based on the types of technologies they're using. So there's a wide variety of patterns, and I would say it really varies by the biggest thing that we look to for these patterns is how sophisticated is the actor. But then another reason why this is important is because let's say you don't know, let's say someone is using cryptocurrency as simply a layering stage and all you have are the patterns. You don't have a source of funds coming from another illicit wallet. You can still do more based on what are the typical behaviors of a illicit transaction. And so those are the things that we'll look for, like the size of transactions and the patterns of how the deposit addresses are used.
Yeah, super interesting. So you mentioned, in the pattern activity, how quickly the funds are moving. So how fast do you think exchanges need to be able to act to try to prevent or inhibit some of this illicit activity that might be flowing through the exchanges?
Honestly, lately we've been doing a lot of tracking for North Korean hacking organizations, and time is really of the essence there. We're talking about, we have teams following these hackers down to the minute, because the second those funds hit the exchange, you want to notify the exchange to get those funds frozen. So in certain types of illicit activity, notably hacking from major nation-state actors, time is really of the essence. If you're too late and the funds hit the exchange, then it's gone. It could be gone. In other types, you might have more time because maybe you're building a longer case. Right. If you're investigating a scammer, it's not a time is of the essence situation, but it's a let's build a thorough case of which blockchain transactions are one part of a greater case. And that I imagine you probably have more time, and the legal system means that you have a lot of time to get everything in order.
Yeah, absolutely. Well, Kim, it was such a pleasure talking to you today. I always feel smarter after we chat, no matter what the topic is. So thank you so much for coming back on Know Your Crypto Compliance, and I hope you'll join us again soon.
Thanks for having me.
Roger, thank you so much for joining me today on this episode of Know Your Crypto Compliance. Roger is our head of global tax here at Chainalysis. So let's jump right into it. Would love for you to just tell us a little bit about yourself and your experience and how you got to Chainalysis.
Hey, thanks so much for having me. I'm an international tax lawyer. I've been one for a long time. Started off with the classic things in international tax that people do. My focus for most of my career has been international tax for financial services entities and financial institutions and products. That got me into fintech. Fintech grew out of basically people wanting to do financial things in a more technologically enabled way. Crypto began as a financial product, a means of payment, Bitcoin. That's what the Bitcoin white paper is about. And people started doing ICOs, asked my advice. Lots of structures were international in nature, and that was my gateway into it as a partner at a Big Four firm. Chainalysis, got into it as saw one of Kim Grauer's webinars, and I thought, wow, the tax implications for blockchain are massive. I really want to be doing this inside a company that having that thought leadership, and I directly tell people Kim Grauer is the reason I'm here. So here I am.
That's awesome. I never knew that. And Roger and I actually worked together, and I never knew that Kim was the way you got into Chainalysis. Kim is awesome. So that's no surprise there. So you mentioned ICOs. So that would have been what, 2016, 2017 timeframe?
Correct. So I was in it before, answering tax questions around Bitcoin. The main issue there is Bitcoin currency. and that has tax implications around how you treat it as an asset from a tax perspective. Can you market to market? The character of income were the main issues. And then when ICOs became a thing, people kept coming to me because it was weird, it was financial, it was digital, it was fintech, and that's kind of what I was doing. So I was 2015-ish started, and then with 16, 17 ICOs, that's where I was giving advice on structuring.
Got it. That makes sense. So tax is obviously a complicated topic to begin with, and then you bring crypto into that, and it becomes even more complicated. So I'm assuming you like a challenge, and that's kind of where the crypto nexus came into this. Why you enjoy it so much?
That's exactly right. Tax is when you read tax in the abstract and the tax code rules, you wonder who wrote those, because sometimes they just make absolutely, in terms of an absence of clarity, or a complicated way to say simple things. The tax code has a lot of those kinds of provisions in it. So tax people tend to be the interpreters. You're absolutely right. Crypto does represent challenges, and in practicing tax in crypto, you're always looking for an analogy in the real world. What's it most like? Is it most like a service? Is it most like exchanging an asset for an asset? Is it most like currency? When can it be currency? Because our currency rules are not written as exactly as one might think, and in certain instances, crypto can give rise to the same kind of treatment as if you actually were dealing with a currency or commodity. Commodities are not defined term in the code, so when can you treat it as a commodity as opposed to a security or just some other kind of asset that has different kinds of treatment?
Yeah, absolutely. So we know you might not be able to share all of your experiences, but what would you say has been the most project that you've worked on crypto tax related, either at Chainalysis or in your previous life before joining Chainalysis?
I think crypto related, I would say it was probably the ICO work I was doing. Because of the frenzy around ICOs, people would just seek to do them in any way possible. And it actually was, some people did a very inefficient structure where they would issue tokens through a domestic entity, immediately give rise to taxable income. When the tax rate was 35% of your proceeds are just gone now in tax, selling a zero basis asset. Next, putting in place international structures that would allow one to not have to pay U.S. tax because of the way things were structuring it, and then have the tokens be spent inside the project, or the proceeds from the raised, usually Bitcoin or Ethereum, be sold in a way that would just fund the project development without adverse consequences for only one layer of tax when one would expect it, as opposed to losing the proceeds in an efficient way. That's where I really go.
Super interesting. So you've done a lot of thought leadership since you've gotten to Chainalysis, and I believe you wrote a blog post back in 2022. What are maybe the major differences from 2022 to 2023, or are we still in the same kind of place when it comes to tax?
I would say we're in the same basic place, which doesn't surprise me because tax law is made in a very deliberate way, and it often takes years to catch up with market developments. That's the first piece. Secondly, prior to the Infrastructure Act, there was no reference to digital assets or crypto anywhere in the tax code. So you're basically relying on either specific rules or general rules in how to treat crypto. That's the second resting point. Third resting point is now many more, in the 2001 market, when gains and revenue was all over the place, it's pretty easy to how to deal with certain issues. But now that many people have losses, or there have been market contagion around certain financial institutions or crypto exchanges, you have a host of different issues that really test different aspects of the tax code. I'll just give you one. Lots of people have capital losses. but also lots of people have ordinary income from staking, ordinary income from mining, ordinary income from providing liquidity on a decentralized exchange or crypto interest. All of those things are ordinary. I myself have embedded capital losses. I didn't sell anything, but had I would have a capital loss, but I have ordinary income. So it's kind of less than ideal when I have either these losses or people have losses from their selling crypto, but they also have ordinary income and they have to pay tax on the ordinary income, subject to a $3,000 offset for capital loss against ordinary income. Gee, that's really efficient. Suppose I have crypto locked in an exchange that I cannot get my crypto out. But at some point I may recover some crypto. So how much will I recover? But right now I'm economically harmed because I can't get access to my crypto. I can't withdraw it, including crypto that I might have earned in fees in crypto interest or crypto staking. And now it's unfortunate. I typically cannot take that loss because I don't know how much I'm going to get back. It's locked, and I'll have to deal with that. So these are the kinds of issues now that people have to deal with. There's even others that have experienced scams and rug pulls. The tax law changed 2017 that limit one's ability to take deductions for things like theft. And now people are looking for other ways to characterize transactions to minimize the pain associated with some of the tax law changes that came in the 2017 Tax Act, as well as some of the limitations on ability to take losses like character-based or, gee, things are uncertain, I can't claim it yet because the loss is not ripe, so to speak.
That's a lot for sure. So even though we haven't gotten a ton of new regulation or haven't made a lot of new moves, it sounds like a lot of the events that have taken place, at the end of last year and the things that we're seeing in this year are really going to play a big role in what we're going to see in the future with tax regulation. So it'd be interesting to have you on in a couple months and see if we've seen anything different happen. Well, one final question for you. This would not be an episode of Know Your Crypto Compliance at Chainalysis if we didn't talk about blockchain analytics. So how do you see blockchain analytics contributing to the future of tax regulation?
I think directly related. I'll even start with the Crypto Crime Report, which I hope people have read. In my view, there's a definite role for looking at the tax issues around many of the activities. So like rug pulls, different kinds of investment scams and romance scams. There's actually some now publicly in the IRS, including some mentioned in the Crypto Crime Report, where U.S. people were actually the perpetrators. So the IRS, it's not just countries, perhaps with rogue regimes, that's where the activity is being perpetrated from. It's actually within our borders with people subject to U.S. tax and other enforcement jurisdiction. Again, some of that is already referenced in the Crypto Crime Report. That's the first resting piece. Second resting piece is on-chain activity is visible. And where it's visible and has a risky nature, law enforcement can then subpoena the exchanges where the wallets have a direct relationship, and therefore finding out the names of those individuals. They can also, in certain instances, get that information from foreign exchanges. Different exchanges release compliance reports, transparency reports is what they call, around their responses to law enforcement. And people can type in transparency report and see different major exchanges issuing those. So that kind of information has definite law enforcement benefits because of the transparency of the blockchain. It also has tax enforcement because of the historic issues around people owning crypto based on publicly available figures, and the IRS looking at the disclosures that they're seeing in the tax returns and seeing there's a great disparity. Tax authorities around the world are seeing that, and tax authorities around the world are taking steps to minimize that gap.
It's super interesting. I think every single episode that we've done, we talk about the transparent nature of the blockchain and the different use cases that are coming out. And so, even tax fraudsters are not able to be hidden away by using crypto. There still is the transparent nature of the blockchain that we'll probably start to see, more law enforcement actions coming that way once we continue to get more clarity around regulation in the crypto space. Roger, thank you so much for joining me today. It's always a pleasure chatting with you, and I always learn something new when I chat with you. And join us next time on our next episode of Know Your Crypto Compliance.
Like and subscribe to the Chainalysis YouTube channel to see more content like this, and we'll see you next month with a new episode of Know Your Crypto Compliance.
So, as this space continues to mature, how do you see the relationship between compliance, enforcement, and policy evolving in the tax space?
Great question. I'll give you twofold. The first is we expect a reg package in the very near future on information reporting. So this deals with exchanges having to report A, sales of digital assets, and B, transfers of digital assets. And then C, people who use digital assets to buy goods or services. That reg package was drafted publicly by Treasury. It's been through the White House, and practitioners are waiting for it. It will require basically KYC for a number of exchanges. There'll be issues around what decentralized exchanges, if any, are out. The operative rule are brokers, which is a synonym in effect for that's a statutory word for exchanges. And whether they make a distinction between centralized versus decentralized will be something that is to be determined. Next will be income that's not gain and how they treat it. I talked about different kinds of fee income and how will that be reported, because there's been disparate practice around that. What else? People are thinking about, will there be any guidance on some of the potential losses people have inside crypto exchanges? Will the IRS provide any relief? Can they provide relief? Because the IRS can only act inside the authority granted to them by Congress. And there are certain limitations of when they can act and give relief. And then finally, I would mention the OECD has enacted a framework for exchanging information globally. So if I have an account overseas at an overseas exchange, then I would have to be KYC'd and the information would have to be sent back to the IRS that they would aggregate with all my other trading history and impose appropriate tax.
Super interesting, especially around, the potential relief that Congress could enact, related to the losses that some people are seeing.